At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
At Staples Business Advantage, we help you select from 2,000 breakroom products, so you can be sure there's something for everyone.
Yum. Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
Welcome back to Shares for Beginners. Today, my guest is Julian McCormack from Platinum Asset Management. I met Julian at an investor day put on by the Australian Stock Exchange. I'd highly recommend going to the ASX website and joining up for their events. You can spend a lifetime reading, but hearing the experts speaking and meeting them face-to-face can supercharge your share market education. Julian spoke about Platinum's approach to investment management. They identify and invest in companies they believe to be undervalued. His case study is the German car company BMW. I want you to pay attention to some of the concepts he talks about. There's price-earnings ratio, which is one of the basic ways of valuing a company, and also book value. I'll explain these concepts further on the blog post for this episode. I'll also include Julian's video presentation. Now, this is not a recommendation to run out and buy shares in BMW. This is purely an exercise in valuing a company for you to learn from. Julian, you're an investment specialist with Platinum Asset Management.
Correct.
You first joined Platinum in 2001 and then quit in 2002.
Yeah, that's right.
And went travelling.
That's right.
Yeah, okay. And then you worked at Credit Suisse in metals and mining before starting your own minerals exploration company. And now you're with the Basic Industries analytical team. Do you want to expand a little bit more about your career?
Oh, yeah, that's a pretty good summary. I got this wonderful job at Platinum, but had committed to go travelling. And back in the old days, it was verboten to leave and come back. So so I had a brief conversation with Kerr about leaving in 2002, I think it was. Took off and travelled for a year, which was great. So that was sort of wonderful. Probably cost me a bit of money in terms of how Platinum went thereafter. But I had that sort of great experience at that time. And you know how those experiences in your early 20s are so formative. So this sort of value investing contrarian thing sort of sunk in. But in all honesty, it was awful getting a job back in those days in 2002 and 3. Remember there was that tremendous bear market, but a real one, not a sort of little flash in the pan. It was grinding. It was awful. You just knew the market would be down 20 points every day. And it was a bit before the excitement of the mining boom. You know, the coal price was $20. The iron ore price was $40. So that was all in mining. And mining's a nice business where you can actually understand the cost base of a business. It's not like a widget business like Apple, where you're just sort of guessing all the time. You can actually know, if you move this many tons of dirt and there's this much stuff in it that's of value, you get a good sense of how the business
the numbers are easy to understand.
Yeah, that's
I believe.
right.
Yeah.
And they're real. They're actually, they're deterministic. You can sort of know things, which is kind of nice. Anyway, I quit that to have a go at my own thing, and that the one good bit of that, of a few years of work, was one thing called Valiant Resources, which is, one day it'll be worth quite a bit of money. It might be worth a bit today. But
is this your mining exploration
this is the mining
company?
Exploration thing, yeah. So it's a metallurgical coal explorer and developer in Queensland. It's got this huge deposit up in Queensland. But if you or your listeners are familiar with the shape of the price graph of met coal, I founded that with a couple of other guys in 2011. So by 2014, I was, my beak was pretty dry. The price only went one way for the whole time. But it's an interesting asset that we've got a lot of data around. It didn't need a whole lot of work. So that could just be put on care and maintenance type thing. And
so what first attracted you to financial services?
That's where the money is.
That was it. You just went at a young age, just decided that's where
right.
The money is.
Well, I really had no idea what I wanted to do. Also, though, my old man worked in, planning and stuff. So he'd worked at places like IPAC and BT back in the old days, and Armstrong Jones. And then, I sort of just figured, look, if I'm going to have to work for a living, if we really do have to do this capitalist thing, I think I want to get quite well paid for it. So that was kind of the thought process.
It turns out, actually, we've got a few young listeners and who are interested in this. What advice would you give them if they want to get into the financial services industry?
Well, the first bit is do it. The first bit of advice is do it. So read all the books, right? So hasten slowly. Don't waste your money too much. But you do. If you've got $500 in an internet connection, you can invest. So that's the best way to learn. But before you do that, you do want to read, all the Buffett biographies. So Buffett, An American Capitalist, the Peter Lynch books, so One Up on Wall Street and Beating the Street. The old Soros books are good. So The Alchemy of Finance, Open Society Endangered, Reminiscences of a Stock Operator.
Jesse Livermore.
Yeah,
we've discussed
exactly.
Jesse Livermore.
All these old classics.
Yeah.
Read them all, but invest and demonstrate an interest in it, and not just don't do it for the sake of having it on your CV. Do it because you want to do it, and once that becomes clear, that's the most important thing.
And this is good advice for a beginner in the share game anyway, whether
100%.
Whether you want to work in financial services or not.
Yeah, 100%. So, but then the other part is it is a competitive world and you do want to give yourself all the arrows in the quiver. So you do have to work hard.
So Platinum, where you work, you invest in international shares only, don't you?
Yeah.
I think there's lots of figures that show how little Australian investors and SMSFs invest in international shares. Why should investors in Australia be investing in international shares?
We're not very much of the market globally down here, and we don't have great depth in most sectors. We've got these gigantic banks, so 4 of the top 10 banks, I think, by asset size, maybe 4 of the top 20 globally, plus the massive resources guys, so BHP and Rio. And so the rest of the market's pretty thin, so even, we're a consumer economy. So even in the retailing sector, we're pretty thin, when you go and look at the diversity of stuff that there is elsewhere. But, then you get into biotech or information tech or software as a service or chip makers or oil field services or whatever it is. There's just so much more diversity of that stuff on offer externally. So that then translates into some funny valuation mismatches, right? So we don't own CSL. Wonderful business, but it's a bit expensive. We can buy a stock a company that looks a bit like CSL, has a sort of CSL embedded within it, called Takeda in Japan, for a third of the valuation. It's not that markets in general are on their face expensive. They're not. They're about average. But within that, there's all this stuff that's super expensive, so software as a service or whatever. The corollary of that, so average valuations with some stuff that's very expensive, is there's some stuff that's incredibly cheap. And there's lots of it, and it's oftentimes pretty good. Right, so my favourite example is BMW.
Well, that's a great segue into our discussion about BMW, because we met at the ASX Investor Day, and your presentation was basically about BMW and why you think it's such a great stock.
And what I love about it is it's familiar to people. It's not like Micron, who makes semiconductor chips, or Samsung, who people think they know because they make a Samsung phone. They make DRAM and NAND. This is familiar. They know the product. They get a sense of what the business is. That they can actually sort of touch and feel it. Yeah.
And it's got a great history as well.
Yeah, it's a fascinating history. So that circle divided into 4, it's the colours of Bavaria, but it's also is a stylized propeller. So you know how propellers make that blur when you look at them. many youngsters won't remember.
This is on the badge, isn't it?
Won't know what a propeller is. They made aeroplane engines for the Luftwaffe. So, they were a general industrial company. They began to make motorcycles. They combined with another company. So BMW combined with another company that made plane engines. And the big customer for that became the German Air Force. That was basically bought out of insolvency. Right? So that the assets were still there. They'd been pretty heavily damaged, but there was a fundamental base there and a skilled worker base as well. One family, over time, became became the majority shareholder of that. They're called the Quandt family in Germany, Quandt. They still own 45% of the business. BMW was the insurgent, the upstart, the disruptor, if you will, but with enormous focus on quality. So that whole German engineering thing really seeped into the brand certainly by the 80s.
And just as an aside here,
Yeah.
something that other guests have said is that it's very worthwhile investing in businesses where the owners have skin in the game, where the owners are actually...
Exactly.
And this is the case with BMW.
Exactly.
Yeah.
And the behavior of that is not getting rewarded in markets, by the way. So what is getting rewarded in markets is levering up the balance sheet, paying out massive dividends and doing buybacks. So what we see in the States is capital light businesses that borrow money to pay dividends and do buybacks. That's a pretty short game. That's people remunerating themselves next quarter. That's not people thinking about the next generation of owners. And so one can be pretty assured that when this is a family controlled German industrial with that heritage, we actually know we're not going to get too many fools tolerated for too long.
Yep.
And so BMW has been terribly methodical amidst enormous change in the industry. So everybody will know that electric vehicles are here. Everybody will know that Tesla is the great insurgent of its day. But what people will perhaps be surprised by is BMW started planning for electrification of the drivetrain in 2008. They released their early EVs in 2013. They are the fourth biggest EV, so electric vehicle maker and seller in the world. They sell mostly these sort of little boxy, tinny i3 things, I think they're called. But they have some that are amazing. So if people want to see them, go and look at a BMW i8.
i8,
It's
I know.
incredible.
What a car.
What a car.
It's a hybrid, but it's
exactly.
mainly EV. But
Exactly.
was it 2 litres per 100 kilometres?
Yeah, I mean, and a beast of a thing.
Yeah, and it's a supercar performance.
Exactly.
Yeah.
And so what is really interesting about this is so much of the electrification thing is not about the environment. It's actually about performance. But it's being driven by regulation. So it's the EU and China's fleet emission standards that are driving electrification. So we think at Platinum, our autos guys think the best we can get to across a fleet with internal combustion engines is something like maybe 120, 125 grams of carbon emitted per kilometre. Fleet emission standards in Europe mean you have to get down to 90. And in China, and that's by 2022, and in China you have to get down to 110. So you must have stuff that isn't internal combustion regardless of how efficient you are. And that's what's driving this. That is why the whole industry is moving this way, because they are the two biggest automotive markets in the world, Europe and China. So that's what's driving the change. And it feels to people like one company is sort of winning because they've got all the models out and people, and Elon Musk makes a lot of noise and is full of chutzpah and probably in some sense is a wonderful CEO because he attracts so much attention and probably lowers his cost of capital by doing so. But that is the reverse of what German engineering is about. That sort of, look, we're just going to make it on the fly. We'll change stuff as we go. 2 years after we announce it, we'll have a model out. And now I've got a truck, and now I've got the Model Y, and now I've got the new Roadster, and blah, blah, blah. Real automotive companies don't do that. And maybe that's methodical and plotting and old worldy, but what it means is you make money on the cars. Pretty simple. So at BMW, we've done all of this work. We've done 500 million euro per year of research on this stuff for a decade. We know the battery forms we want. We know the models we're going to release 5 years forward. We know that, so right now in the UK, I think a quarter of all cars that are sold in the BMW fleet are plug-in hybrid. These guys they're into it. It's happening and it's not reflected in the share price. So all of that heritage, all of that investment and all that
quality,
long-term, exactly,
brand value.
Exactly. All that long-term thinking is being given away because the equity market is saying, oh no, because these old legacy autos are hopeless. They're worthless things. And so therefore, on a sort of enterprise value basis, so equity plus the debt in it, Tesla is about the same price as BMW. And Tesla will do generously 300,000 cars a year. And at BM, we're doing 2.5 million. And we make money on the cars, by the way. That's a really interesting start point. That's comparative though. So just the fundamentals of the thing are probably more interesting. We're getting a 5.5% dividend.
Okay, this is where I wanted to dig down because I've got the quotes here. Okay, so with BMW, it's on an earnings multiple that's very low. 7 times forward earnings, 5 times past earnings. Just tell us about that.
Yeah. So let's turn that multiple into a rate because we all understand percentages. And so, people in finance are not very smart and they seek to obfuscate. So there's nothing magical about a multiple, an earnings multiple. If you invert that, you get a percentage. So 1 over the number gives you a percentage. So 1 over 7, we're getting about 14% in profit for equity that we buy in the business today. We don't get it all as a dividend.
So hang on, okay. So if you buy the share today, how does that reflect in those numbers?
So for $1 of equity that I buy, of shares that I buy, I get 14 cents per dollar in profit.
Per year? Per year.
Per year. So that thing is going to pay me back in 7 years, just in profits. Now, I won't get all that as a dividend because hopefully, some of it goes back into the business and compounds at a good rate. Now, this is a sort of mid-teens return on capital business. That is a lot better than you're going to get in a bank. So if you put $1 into a bank, you'd get, 2% or something. If you put $1 into BMW, you get 14% in profit. And of that profit, it will compound in the mid-teens. So you don't just get it once. Right,
so some of it's dividend, and then some of that money is reinvested into the business, which then grows the business and increases the value of the business.
Exactly, and so we get 5.5 of a divvy, and so we get 9 left in the business.
5.5%
as a dividend, So that's paid out to me as an equity holder. I can be pretty assured that I'll get that. Because the Kwanda family don't make any money unless they get divvies. So that's quite nice. They're on our side.
They've got no other way of making money, really, out of it, have they?
Oh, they've got plenty of dough elsewhere.
Oh, of course, yeah. Obviously, yeah. But in terms of just looking at it as a single business, as a unit,
right. Yeah, that's right. They're not employed in the business. They're not, they are a straight equity holder. So that setup is telling you really that the market thinks that this business either can't grow or is sort of structurally impaired somehow. That's roughly the kind of valuation you were getting in the GFC when the world was pretty bad. Another reflection of that is price to book. So the amount of investment, the amount of equity capital that's ever gone into that business, less depreciation.
Okay, let's dig deep here and uncover what you've just said.
Yeah.
Okay, for someone who knows nothing about valuing a business.
Yeah.
Can you explain that a bit more?
Sure.
Fundamentally?
So we can only finance a business one of two ways. We can put equity in and we don't necessarily get paid back, but we get the profits. Or we can put debt in and we do get paid back plus an interest rate, but we don't get the profits. So we've got sort of uncertainty and upside versus certainty and no upside. When we're buying stuff at equity value, so when we buy it at book, that they're interchangeable, book value and equity value, same thing. When we get that, what we're getting as a market pricing is the value of all of the equity capital that's ever gone in to that business, less anything that's been depreciated or written off. So that's a pretty good measure. There's nothing definitional about that, but it's a good measure of how fundamentally cheap something really is. Right. So in the case of an automotive business, if these guys had been really lazy and hadn't invested in their business and weren't ready for electrification, you might actually price the book at a discount because you might think, oh, hang on, these guys are under investing and they're going to have to plow so much money back into this business that there's no way.
They've got to play catch up.
They've got to play catch up. Exactly. That's actually the inverse of what the case is with this firm. This firm is ready to go. They have to take a very slight earnings hit depending on their pricing to get to full compliance with EU 2020, which is the leading regulation in the world. So that's really interesting because we're buying this thing on 0.7 of book. Right. So 0.7 of the value of the equity investment in the thing ever. And we're getting that at this kind of discount. And most interestingly, that's about the lowest it's ever been. So in any recession, in the GFC, anytime. That's as cheap as it's been.
At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
Suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
At Staples Business Advantage, we help you select from 2,000 breakroom products, so you can be sure there's something for everyone.
Yum. Sign up today and save 20%.
Staples Business Advantage.
Business is
Human.
But that's not the end of the story, is it?
No, exactly.
There's more. There's better. That gets better.
That's right. That's right. Thank you for reminding me, because the balance sheet's ridiculous. This thing is so conservatively.
And the balance sheet is
So the assets of the business. So we've, all the stuff we've been talking
everything
about,
that they own.
That's right. And remember, we can finance this with debt or equity. Mm-hmm. There's a wrinkle to that because this business has a pretty high financing component to it. That is incredibly conservatively geared. So an average bank will be 10 to 15 times geared. I think we're 4 or 5 times. We are 4 or 5 times geared in the financing business. And the financing business. So that is, I want to go in and I want to buy a car, but I don't want to cut a check for $75,000. How about I give you a down payment of 10 or 15 and pay you back over the next 5 years? That then becomes a receivable because that's going to get paid back to that business. Mm-hmm. Or we're selling into lease fleets. And so the leasing thing is I still own the car, but I'm getting paid for the.
So BMW still own the car,
yeah,
but they're getting the.
So we have lease assets and financing receivables. Mm-hmm. So net of those things and the cash on the balance sheet, we're getting the automotive business here for free, right? That's remarkable. And also, I don't want to give people the impression this is real smoke and mirrors type House of Cards stuff. We made money in the financing business in 2009. We took a write down, but we had a positive return on equity in the financing business in 2009. So this is a very conservatively put together business all the way through its core. And having that sense of what the heritage of the business is, one might get a sense of why. Because we're running it to be intergenerational. You know, we want this thing to be here if we're the Quant family forever. That is so incredibly different to the behavior that we see in places like the States, less so Australia, but to some degree, where the behavior that's being rewarded is this ultra aggressive and incredibly highly geared behavior where we're either borrowing money or using equity capital, particularly to pay our staff, and just wanting to grow like stink, as if things can grow ad infinitum. And also, and in fact, if they're investing for growth, it'd be fine. But largely, we're borrowing to buy back stock. Now, that'll work until it doesn't. And when it doesn't, we're just going to end up with a lot of debt and nothing on the asset side of the ledger to justify it. We just will have shrunk our our share count and end up with a higher share price, all other things being equal. So in that context, a business like what I've just described just looks so delightful as someone who wants to invest over long periods of time.
Okay, at this stage, we should also put in a disclaimer in that we're not recommending that anyone goes out and buys BMW shares, but they
Precisely.
should talk to their financial advisor and have their own needs assessed.
Yeah. And I want to take you up on that because I do really want to impress upon people, if you don't think you need financial advice and you can't afford it, you probably need it most. And if you think you're terribly clever and you don't need financial advice because you're really too sophisticated to need it, well, that's crazy. Rafael Nadal has a coach. Do you think he knows a lot about tennis? He knows a hell of a lot about tennis. Mm-hmm. So why would he have a coach? It's accountability. It's people reflecting your own behaviours and statements back to you. What last year you told me you wanted to save for this and you've gone and done that holiday in Europe. What's going on? That kind of stuff is incredibly valuable. And the nature of Australia's savings system and our superannuation system, with a huge pool of capital, so 2.4 trillion, whatever it is, and massive discretion or very significant discretion with the user of it, is we don't see that anywhere else in the world. That's nowhere else in the world. And we've had 28 years since a recession, and super was brought in about the same time we had our last recession, by the way. So that's positioning people for failure if they don't get advice and if they don't take it seriously and get a coach in this stuff. They're just going to, they're not doing themselves any favors. So it really is important to get advice.
That's a great analogy, saying that it's having a financial coach to help with your investments. But if someone is going to go and see a financial advisor, what sort of questions should they be asking them to make sure that they're being looked after, that their interests are being looked after?
Good question. I'd suggest that it's about having a sense of trust that the other person is both qualified and ethical. I don't know of any way to prove that a priori. It's difficult because, these are sort of human interactions which are difficult. But what people 100% can do is contact financial planners in their vicinity, ask them just for a quick one-on-one meeting for half an hour. Everybody wants to do business development. So business development is investing in your own business, right? So if you're a lawyer, an accountant, a financial planner, an engineer, or whatever, you want to be talking to people to get new business. So please don't think it's an imposition on them. It's the reverse. It's how they grow their business. Go and see them. Go and talk to them. Go and ask them in general terms about your circumstances and what you should do and how they can help you and whatever. And then you might want to take a few up on the first consultation. And I think by the time you have a proper consultation, you probably want to pay them just for their time. I mean, these people are professionals. And once you've done that, then you can be pretty assured that at least you've given yourself the tools to know that you might be in good hands.
We've got a listener question.
Great.
This is from Mackenzie. Related to ethical investments, many technologies that we have the privilege of utilising today wouldn't be possible if not for mining. Many commodities used in the manufacturing of renewable energy technologies require mining also. However, where does one draw the line when some mining companies have been caught up in human rights violations and have serious negative impacts? Is it possible to invest ethically in mining? Kind regards, Mackenzie.
Yeah, it's a great question. The thing about ethical investing is ethics are personal. This is what I find. I'm just going to stray a little bit from the topic of the question just briefly. And the finest minds in the world have thought about ethics for 3,000 years. So the notion that people can sort of tick all the boxes with an investment product and say this is an ethical investment, I think is really strange. So coal is the really pointy end of the spear here, where I don't have any question that we actually need quite a bit of coal for quite a while. And if we want to shut miners down, so half of the world's seaborne metallurgical coal comes out of BHP Mitsubishi Alliance in Queensland. We do in total about 450 million tonne of coal in this country.
And metallurgical coal
goes into steel making.
Yeah, so it's not for making.
No, so we do about 180 million tonne of metallurgical coal, and then 270-ish of thermal. The problem is if we want to shut that down, and we tell ourselves we're being ethical in doing it, we must know that will get replaced by some other unit of coal. And we know where those units of coal will come from. They'll come from domestic Chinese production, which is the biggest industry in the world. They'll come from Indonesia. They might come from Mongolia or Mozambique. Might come from Colombia. All of those units of coal are less efficient than the one that's coming out of Australia. So Australia has this lovely, clean, low sulfur, high calorific value coal, and it's in general quite dry as well. That is comparatively more or less damaging than any other unit of coal, basically, that you're going to get anywhere in the world. So it's a very fraught question, this thing about ethics, because if we don't understand the full playing field, we can actually really do ourselves a disservice. And to put that in context, don't think that 450 million tonne coming out of Australia is a big number. China burns 3.5 billion tonne a year. So we're going to be a rounding error, and we're going to replace our coal with lower quality, higher sulfur coal. That's a bad outcome. That's an unethical outcome, right? So, specifically to Mackenzie's question, which is more about, I think, sort of labour relations, every significant mining company releases in their annual report an ESG section, You know how many people they hurt or kill. You know what they're doing environmentally. And if one wants to own one of these businesses, you just have to understand the nature of that business. And these are really significant things. These are not feel-good tree-hugging type things. If you're doing things poorly environmentally and you're hurting and killing people in your operations, you have no operational control. That's a bad operation, right? Not just because it hurts people. It's because, from a process control perspective, that's bad practice. So yeah, you have to take that stuff really seriously. But it's all disclosed. It's all in the annual accounts. It's all, there to know. So, right at the pointy end of the spear, we're very interested in cobalt. That's a really fraught metal.
And that's the where you have the miners in the Congo.
Exactly. Exactly. And it's a huge problem.
And so we need cobalt. Everything's got cobalt in it as well. Yeah.
Yeah, exactly. So the mobile phone battery in front of me right now has, it's probably an 811. So it's got, in the battery will have, 8% cobalt. So, it's there. It's real. If I'm picking it up and talking into it, I need to ethically own up to that. But what you can do is know that the businesses you're investing in are either there's a verification thing coming in around ethical sourcing of cobalt. Apple's moved to full ethically sourced cobalt, et cetera, et cetera. So these things are all knowable and analysable. And yes, you can, pay attention to it. It is as simple as reading the annual report.
Let's wrap up and have a look at Platinum, where you work, Platinum Asset Management.
Right, so we're about 100 people in total, about 35 in the investment team. We run just on 25 billion Australian dollars, and it's totally global. So we've got very rough numbers, about 20% of our money in North America, about 20 in Europe, about 20 in China, then 10 in Japan, and other Asia is most of the rest. More philosophically, what we are trying to do is buy cheap stuff and sell expensive stuff. The reason we're trying to do that is because we want to be custodians of people's capital. So we're not happy when we get a bit left behind by markets, but we're not terribly sad when we think they're being crazy. So when they're being really exaggerated and wanting to send valuations to the moon, we're happy not to participate, because what we want to avoid is that 2000, 2007, 87 style event where you get huge drawdowns because of the incredible excitement that went in there. So we'd much rather a BMW to a Netflix, that kind of thing.
Mm-hmm. And people can invest via a number of ways. I mean, you can even buy Platinum Asset Management as a stock itself, or you've got I'll let you explain it.
Yeah, exactly. Well, all we want to do, we do want to avoid sort of product proliferation for the sake of it. But what we do want to do is give people as many ways of accessing what we do as possible. So people can buy listed investment companies. We've got and the virtue of that is you get a franked dividend. So there's one called Platinum Capital, PMC, and Platinum Asia, PAI, on the exchange. People can buy ETF-y style things. They don't get a franked dividend. They get a distribution that's a bit lumpy. And that's PIXX for the international and PAXX for the Asian fund. Or people can go to our website, so platinum.com.au, and have a look through our entire suite of 8 unlisted managed funds. So that's international and Asia. We've got a consumer fund, a brands fund, an unhedged fund, which is long only, a tech fund, a healthcare fund. I'm forgetting someone and they'll kill me, but that's all right. A Japan fund and a European fund. What we've always sought to avoid is decision-making by committee and consensus. So if we're all of one mind and we think that we know something, all of us all together, we're almost definitely wrong, because we're missing something. Nothing is ever certain. So people must avoid the sense that markets are in any sense mechanical, and we can know before an event what the outcome will be, like a machine. So I pull a lever here and a ball drops out over there. It's not how it works. It's much more like fluid dynamics or material sciences. When things are put under stress, we don't know when they'll fail, but they will fail. We don't know when an avalanche will happen, but we know when the risk is high. These things are unknowable, but we know the probabilities around them. That's a much better way of thinking about what markets are and how they work. It's a massive chaotic system. And when that system gets stressed, then you want to be very careful. And so what I started off by talking about with this very, very high valuation, that is a system that's stressed. That is a system that's very different to its history on average and is not behaving like it has in the past. That looks a bit like an avalanche. Now, I can't tell you what snowflake makes the avalanche happen, but I can tell you that there's some risk of it, that there's this huge divergence in valuation in stuff, and it looks very risky. And then at the other end, you've got all this other stuff that's hopelessly undervalued, and I can't tell you when that will not be undervalued, but I can tell you it is, and I can tell you it's pretty, that looks, in reverse, it actually looks very, very safe. Right? Provided we understand the balance sheet and how the business works. The stuff that's undervalued and feels lousy, it's probably very safe because it's cheap. Price is the main determinant of risk. So that's how we think about the world.
Julian, thank you very much for joining us today.
Thanks, Phil, very much for the time. Greatly appreciate it.
It's great. Great interview. Thank you very much. Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any shares based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. And I'd also like to say a big thank you to Christopher Soulos of Garlic Breath Studios for all the fantastic help with the music production.
At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
Recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes. Only algorithms.
At Staples Business Advantage, furnishing your office is easy. And with the best warranty in the business, we're committed to you now and down the road.
Sign up today and save 20%.
Staples Business Advantage.
Business is
Human.